get started. Hi, everybody. Thanks for listening in. What I'm going to do is to give you an update of our latest views using end June liquidity data, which is basically come in over the last week or so. We've put together and disseminated that probably already to many of you as clients. The main theme is identified, I think, on the title, and that is the view from Twin Peaks. That is really a play on the idea that liquidity has already peaked around the end of last year, and the world economy is seeing a peak right now. I mean, whether it's a mini peak or not, we can debate, but it looks like things are slowing down markedly in a number of areas, but particularly Asia. In terms of the picture, let me just give a little bit of a refresher for those of you that are unfamiliar with this. We're looking here at global liquidity, and the chart is basically detailing the rapid climb in global liquidity, particularly over the last 2 years. But as you can see here, going right back to 1980, and this is the amount of liquidity, credit plus savings, that are winging their way around the world economy. And you can see the various sources of that liquidity broken down, of which is worth highlighting the fact that China is an increasingly large player, and China, which is, you can see in the mountainscape in that sort of bottom right-hand corner, has come from virtually nowhere to be one of the largest, if not the largest player worldwide. In terms of interpreting that data, we look at the momentum of that series. It's not strictly a growth rate, but it's basically a combination of growth rates country by country plus deviations of various ratios from trend. But effectively what it shows is a comprehensive index which is designed to unambiguously track liquidity worldwide. You can see on the chart the index, the GLI index that we show here, which tracks back to 1965 with annotations, how that has evolved. And it's probably pretty clear that if you look at the latest inflection, we've got a very clear peak at the end of 2020, which is now basically descending. In fact, last month in the June data, there was a very small uptick in global liquidity. However, once you drill down into that data, what you find is that it was really emerging markets which were responsible for most of that pickup, a little bit of a catch up with the developed world over previous months. But the developed world number, the major economies, the advanced economies, still showed declining liquidity in June compared with May. To give an impression of what's happening country by country, this heat map basically shows the last 2 or 3 years to show the evolution. That gives us sort of maybe a snapshot of what you can see beginning to appear in the lower right-hand corner with countries like Japan, UK, Switzerland. China has sort of persistently been kind of below average through this cycle. Those are beginning to turn away from that sort of bright green, which indicates strong ease. Even if you look at the US line, which is 4 down, you can see that the US itself is changing color. It's moving away from that bright green towards a paler green, and then ultimately towards this sort of yellow-orange hue. In terms of the changes over 6 months and where liquidity stands, I think you can see impressionistically from these two data rankings that on the left-hand slide, in terms of the index level of liquidity, world liquidity, the red bar on the left, is above average. It's coming down. What's lifting it or keeping it up is predominantly the Eurozone there. India and Australia are relatively small players in that. The US is sort of below the world average now in terms of level, and bigger players like Japan, China are sort of down towards the bottom of that chart. It's more dramatic if you look at the right-hand area, which is looking at changes in the index over 6 months. There's been some noticeable casualties. The UK, I'd point out, where there's been a very marked tightening in UK liquidity conditions that is sort of beyond the rhetoric of the Monetary Policy Committee in the UK. Monetary conditions in the UK are tightening quite noticeably, and we'll highlight that a little bit later. But you can equally see that US, Japan also are edging down, Eurozone's even edging down from its higher levels. And a lot of the momentum is really contained in little bit increase in China, little bit in Australia, etc. But the broad tenor here is that liquidity is rolling over. Now, why is that important? Just as a sort of refresher again, we see the problem not so much in terms of the cost of debt. That's not really the key issue in terms of the problem. The problem is that the world financial system is no longer a new financing mechanism to raise new capital. It's much, much more a refinancing mechanism to basically roll over existing debt. And what you can see in this chart is the rapid climb in the amount of debt outstanding in terms of trillions of dollars on the left-hand scale. And then matching that to some extent, there's the rise in liquidity, which is the red line. Now, there is a symbiotic relationship, I suppose, until there isn't, between liquidity and debt, insofar as that liquidity is increasingly fueled by debt. When debt acts as collateral, you can use that collateral to basically borrow against. And that is a source of credit, and it's an increasing source of credit over the last probably 2 decades. But on the other side of the coin, debt needs liquidity for refinancing. In other words, debt has to be rolled over. And the fact is that many central bankers and a lot of economists tend to forget this fact. But what you need is to refinance any term debt. So in other words, if you have a 5-year bond, you've got to refinance that bond in 5 years' time. And that requires balance sheet, requires balance sheet capacity, which is all determined by liquidity, the available liquidity. So bottom line is, the more debt we have, the more liquidity we need. And whenever you see financial crises, particularly recently, they're all about a story of liquidity dropping below levels which facilitate debt rollover. So you get basically debt crises beginning to emerge, central banks panic and they put more liquidity back in. Now, just one little bit of maths, or just to highlight what we mean by this, is just to bring this out maybe again with one simple equation. What this is really trying to say, and again we're repeating the thesis that we've had for many, many years or decades, is that you cannot use PE multiples to really measure or evaluate macro markets. They work well at the security level, but they certainly don't work at the macro level. And the reason is explained in this equation, which says that the aggregate market PE is really made up of 2 subcomponents, which is the term on the left highlighted in orange, which is the amount of, let's call P market cap, relative to liquidity. So that's some measure of portfolio exposure, how much equity you've got relative to liquidity. And the second is, if you like, excess liquidity, the total amount of liquidity normalized by GDP, or the amount of money that the real economy needs. So let's call the first portfolio exposure and the second financial liquidity. And those are like 2 blades of a pair of scissors that effectively determine the PE level. And they move around a lot. So what we're focusing on primarily is that second term, the red highlighted area, the amount of excess liquidity. But it's well worth paying attention to portfolio exposure as well, because that can actually tell us a lot about warning signs and how saturated portfolios are. So let's look at that first. Here you see that ratio of total equity holdings to world liquidity or global liquidity going back to 1980. Now, you can really view that chart in terms of 2 halves, I suppose. The period in from 1980 probably through till year 2000, where what you saw was a progressive climb in equity exposure, which I think reasonably you can argue was all about market deregulation, was about factors like aging societies, the need for duration in portfolios, the need for more financial assets, and an environment where the tax background was favorable and inflation was low. People wanted financial assets, and that was really that story. Then you see in a kind of a, let's say, a flatlining broadly, or an equilibrium level at around about that sort of 0.55 area, that ratio. But you see big cycles around that, And those big cycles tend to be associated with sort of periods of market bubbles like Y2K, like the period just ahead of the global financial crisis. Arguably we're getting close again now. It doesn't quite come out of the global data or the world data, but you've got to say that that chart is elevated, and it's certainly a long way from where it was in March of 2020. If you look at the US equivalent, then you start to feel a little bit more uncomfortable, because if you look at equity holdings and liquidity in the US, we're still at where we're at rather elevated levels, which are kind of getting up to where we were at the time of the Y2K bubble, well above the 2008 levels, well above where we were in March of last year, and even well above the areas we were trading at, let's say 2018. So in terms of equity exposure, there's an issue. There's also an issue in terms of the liquidity cycle and what it means for equity markets. What I've done there in this chart is to go back, right back to 1970, and to look at the 6-month change in the MSCI World Index, which is the blue line, and the 6-month change in our global liquidity index, but advancing that by 6 months so it's predictive. Now, you may have to go slightly boss-eyed to sort of see the correlation there, but you've got to argue that in periods where liquidity dips noticeably, you've got to be very wary about risk assets, because that's really what's driving them. And what this chart is saying is we've had a fairly pronounced drop now in global liquidity conditions. Look at that another way, on a shorter time horizon. This is going from year 2000 onwards. It's looking at the track of global liquidity. But here what we've got is we're looking at total world wealth, which includes gold and housing wealth as well as financial assets, bonds, stocks, etc. And what that black line for world wealth is indicating is that, we're very elevated. We're at about 12% year on year in terms of the gains, but it's beginning to inflect, and the liquidity cycle as of where we are now is seeing lower and lower rates of growth. And this is in terms of the dollar amount, but our liquidity index, which is more sensible, more sensitive, is already turning down in a more market fashion. Now, let's just explore what's going on with liquidity. And again, let me just give you this refresher, which is basically comes from the book that I wrote a couple of years ago called Capital Wars, which basically is exploring the role of collateral and the role of central bank balance sheets and maybe offshore money markets too in the liquidity creation process. Now, as a sort of very quick heads up, the inverted pyramid on the left is basically saying that you have a stock of global liquidity that rests on a base of high-powered money, which is indicated at the lower part of the pyramid, the inverted pyramid. And what's important is central bank balance sheets, in other words, Fed balance sheet, offshore wholesale markets, things like the Eurodollar markets, but they've been virtually sort of emasculated now in terms of a lot of the regulation. They're important, but nothing like as wayward as they once were. And the pool of collateral, which is becoming, which has become very important in terms of the delivery of liquidity. Now, if you look at the right-hand chart, you've got two choices. One is the conventional money multiplier, which is the blue line, which is the textbook version of how the monetary system works. So it's saying, let's look at the value of total credit divided by the monetary base, the traditional monetary base, the central bank balance sheet. And you can see there that that blue line is collapsed. Or what you can do is to take, let's take the orange line, that's probably a more straightforward definition, which is looking at the total pool of collateral plus central bank balance sheets and looking at that ratio or that ratio between total credit and that extended collateral pool. That's remarkably stable, and that is what's driving the liquidity story right now. In other words, you don't just look at the central bank balance sheets, you've got to look at the pool of collateral. Now, stage one is what's happening to central bank balance sheets. And this chart here is indicating central bank liquidity injections. What we've always done is to look at what central banks do, not listen to what they say. And it's a question of looking in detail at both the size, the structure, and the composition of central bank balance sheets to do this, something I've been doing since the late 1980s, having learned that trade or that skill at Salomon Brothers. Now, basically what you can see there is a very significant downturn, which is occurring in all three: the ECB, the PBOC in China, and the US Fed. The US Fed is quite marked, shown by that black line. That is clearly a point of some debate, which I want to go into, but that's the story in terms of central bank balance sheets. They're rolling over. The impetus of liquidity is it peaked in late 2020. If you look at this table, what it illustrates is the contribution of central banks to liquidity in terms of their normal shares, which is the first column on the left. And that's saying that basically what you've got is the US Fed, the ECB, the Bank of Japan, and the PBOC, roughly speaking, 20% each, and others, all others, again, another 20%. Japan tends to be relative, it's got a big balance sheet, but its presence in global liquidity is a lot less. So you're really left with Fed, ECB, and PBOC as really the key players. Now, if you then look at the final column on the right, what that's saying is over the last 3 months, some 85% of all the QE came out of the US Fed and the ECB. And our point is that that is starting to come down quite rapidly. Now, if you look in detail at what the Federal Reserve is doing, this is a chart which I think is illustrative or pretty informative. Now, it's contentious because many people argue a different story, but let me give our side of it. What you can see there is not the balance sheet, but base money in the US, which is basically part of the balance sheet. And what we've done is, let's call it the effective balance sheet, because it's the amount of balance sheet liquidity that is circulating in money markets or in the private sector, if you like. The yellow line is money that the Federal Reserve is taking out of the system through reverse repos. And what you can see on the diagram is a huge uplift in terms of reverse repos. Now, the positive case that people put for this is that this is purely fine-tuning, and broadly speaking, it is an attempt by the monetary authority in the US to stop repo rates going negative. And so what they're doing is they're basically providing a floor by giving lots of liquidity into the lots of collateral back into the system through reverse repos. Well, okay, I can accept that. The fact is, though, that they're actually withdrawing liquidity at the same time. And if you look at the red line, which is the effective balance sheet size, what you can see is that the balance sheet's actually the effective balance sheet's actually falling. So it's true that the Federal Reserve is giving collateral back to the market, but simultaneously they're taking liquidity out. And it's the liquidity side which I think is more important right now. And you can see historically, if you go back and look at their activity in terms of doing reverse repos, so in other words, selling bonds back to the market, what you can see in that instance is that every time they've done that historically, they have slowed down the growth of base money. And let's not get too hung up about base money, but let's think of it in terms of the excess liquidity in US money markets, better way of putting it. Now, the collateral problem is shown here, and there's no question there's a shortage of collateral in the system, and the private sector needs collateral. And that's one of the reasons that yields are so low. Now, I think this is a sort of maybe an eye-watering, an eye-opening chart, because it basically shows the net supply of US Treasury collateral. So it's basically all coupon bonds to the private sector. It excludes bills here. But what it basically is showing is that since the COVID crisis, through a combination of steering issuance towards the very front end of the curve through Treasury bills and through the Federal Reserve buying lots of coupon debt, the amount of coupon collateral that is in the private sector has shrunk markedly. So that's something to think about in terms of this general equation about liquidity. Now, does that matter? Well, if you can bear with this slide, let me just try and give our side of the coin, if you like. Now, I don't want to work through this too much, but I'm just going to highlight a couple of things, because what this is basically saying is how the liquidity mechanism works. The top line and the bottom line are the key things to focus on without getting too hung up about the sort of the mathematical symbols in the middle. Effectively, what that's saying is that liquidity in the world economy is made up of private collateral factors and a central bank factor. Okay, and you've got a collateral multiplier, which is called it M1, and a central bank balance sheet multiplier, which is M2. You know, a reserve multiplier or a money multiplier, whatever you like to call it. Now, the issue is that what is important is private collateral, and private collateral, as that very bottom line is saying after rearranging these various terms, depends on the total amount of collateral that's issued minus the amount of collateral that's hoarded and not recirculated in the system. So institutions just sit on that because they're kind of nervous and they don't want to lend it out for rehypothecation or whatever. And you've got the other term, which is shown just next to that, which I've highlighted in orange, which is the difference of these multipliers times the amount of collateral that central banks hold. Now, most of the debate that people, you know, the arcane debates about, you know, is the Federal Reserve taking collateral out of the system and tightening liquidity by QE processes? Are QE processes generative of liquidity or not? There's a big debate about that. And what people are really arguing is whether the M2 multiplier is bigger or smaller than the M1 multiplier on my definition here. I don't think that's the issue. The issue is the first term, the red one. And what that is basically saying is that if you look at the amount of collateral that is hoarded and not recycled into the market, it's very, very sensitive to the amount of liquidity in the system. And what I've said here is that institutions tend to hoard liquidity when liquidity generally goes down, which causes an accelerated decline. And that's the problem we want to avoid. And that's what we're, if you like, pointing to now, is that declines in liquidity can suddenly cascade downwards and get out of hand, which then reinforces debt problems and causes central banks to come back in. So that's the mechanism we're more concerned about. And therefore, any moves by the central bank to reduce liquidity in the system, I think are very dangerous, because the whole system is very leveraged right now. Now, let's just look a little bit more at the QE process and work this through. What I've detailed here are QE from 1 to 6. Now, back at the time of the global financial crisis, one of the things we said is you must never think of QE as a one-off. It's going to become a sequence of programs, support programs, that will be differentiated by numbers. And it's like, if you like, popping a series of pills. And what the central banks now have got a bottle of pills, and they're dropping one after the other called QE1, QE2, QE3, etc. And this is the catalog. And if you look at the total amount of liquidity that they've spooned into the market since the GFC, this is the Fed alone, it's 50% of US GDP. And these are huge, huge amounts. The system is not working properly if they're doing this. Now, what does it mean? If you look at this chart, which hopefully conveys the message, what I've done is to show the 10-year Treasury yield, which is the red line, alongside our estimates of the US term premia on the 10-year bond. And the gray areas are these QE periods, including the Operation Twist. So there are 6 QEs and 1 extra, which is the Twist program. Generally, I would argue that during periods of QE, when liquidity is being injected, what you find is that term premia tend to go up. So in other words, what is going on here is that institutions don't want treasuries. So they're basically getting rid of them. They want risk assets in that environment. Their risk appetite increases, yields tend to rise, the yield curve steepens, term premia go up. As soon as you get liquidity being tightened in those white areas, what you find is the reverse happens. Term premia tends to come down, yields tend to drop as a result, and the yield curve flattens. And I would argue that since this accelerated repo activity, reverse repo activity by the Fed, what we've had is a de facto end of this QE process. And that's basically what's going on, right now. I think I put somewhere back here, maybe I didn't, oh, yes, here. Look at that statement, which was yesterday at the top, which came out from James Bullard from St. Louis Fed. Bullard said yesterday on the Wall Street Journal, I think it's time to pull back these emergency support levels. It's a good time to taper. He's been forefront in this, but the voices are getting louder and louder. I think it's already happening. Therefore, if you track liquidity, what you find is that liquidity, which is shown as that yellow line on this graph as an index, tracks remarkably well against the real yield curve here, which is, I think, a decent predictor of the term premia in the US, or measure of the term premia. And what this is basically showing is that, generally speaking, everything is on track. What you're seeing is an inflection occurring in yield curves because of this move down in liquidity. And by the way, liquidity here has been advanced by 9 months, so it's a leading indicator. And what you're getting is exactly the timing that you would expect. So as liquidity falls, the real yield curve should flatten, and that should be translated into the nominal curve. Now, let me just say a little bit about exchange rates and yield curve flattening in terms of this policy mix diagram, which is how we tend to think about the regimes we're in. Now, you've got 4 regimes that we identify, which are basically yield curve steepens, yield curve flattens, exchange rate falls, exchange rate rises. And we're thinking here in the context of the US dollar and the US. Monetary policy, central bank balance sheet is shown on the left axis, and fiscal policy in terms of stimulus is shown from right to left. Now, I put in brackets after fiscal policy, private sector liquidity, because what that's really saying is that if you get a looser fiscal policy, the private sector becomes very flush with cash. In other words, as the government spends, the private sector tends to get greater cash flow. Now, in an environment where you've got a very loose fiscal policy and a very loose monetary policy, the yield curve steepens. I'd argue that's the regime we were definitely in last year, no question about it, okay? If you get that environment, you should see as monetary policy tightens, the exchange rate beginning to rise, or equivalently, if you see a very loose monetary policy and the fiscal mix begins to slow down or tighten, the exchange rate will fall. The reverse of that is to say that fiscal policy is tight and monetary policy is tight, and then you get the yield curve flattening. Now, the point about that fiscal and monetary dimension is that I would argue that monetary policy is inflecting now, and we're in that lower half of the diagram. You might argue, as a result of that, that we could be seeing yield curve flattening, and we might be seeing exchange rate, the dollar, rising. It's possible, but if you go back to that term in brackets, private sector liquidity, the other thing to think about is whether liquidity is leaving the US. In other words, that as the fiscal policy loosens more and more, what you find is that more and more dollars tend to migrate internationally. And that's one of the concerns that we've had, which I just want to focus on here. Now, this is a chart we often show. It's very helpful in understanding the picture behind the dollar. And what it's trying to illustrate is the movement of capital flow worldwide. The black is what I've dubbed here the Americas. The blue is Europe, and the orange is Asia. Now, the reason for that slightly odd sort of labeling, Americas rather than US, is that if you look at pure US data, it excludes a lot of offshore booking of dollars or dollar instruments, such as occur through the Cayman or Bermuda or whatever, because those areas are where hedge funds tend to operate, and they're there for tax reasons or regulatory reasons. And although they're US entities, they don't get logged in the data. So if you do it the other way around, you can actually get a much truer picture. And here the US is or Americas are the residual in the picture. And we've used Asian and European data to basically get that capital flow mix much, much more accurate. Now, what this shows are 3 periods of big dollar demand, mid-1980s. I've gone through this before many times over the last few months. Japanese insurance companies buying. Middle to late 1990s, Asian crisis, big demand for US safe assets. And then the post-GFC Basel III regime, European banking crisis, China corruption crackdown, all these things, whopping great demand for dollars. To scale that, and you can see as a percent of global liquidity, dollar demand has really been skyrocketing. The COVID crisis gave another leg up on that. The slight difference or wrinkle in that latest upswing is that there's been increasing demand for US corporate paper and for US tech stocks through that period rather than US treasuries, but nonetheless, US assets have been in demand. What you can see the beginnings of is a turning point, an inflection. Money seems to be stopping its outflow from Asia. It's beginning to come back, and the US line may be peaking. That could be telling us something about the dollar going forward. Here is a chart which corresponds to that, which is looking at the trade-weighted dollar. And what that basically shows is periods where the dollar is well above its normal downtrend in terms of the real trade-weighted exchange rate coincide with those periods that are highlighted of excess demand for US safe assets. Mid-1980s, end of the 1990s, and the period since the GFC. All those periods when safe asset demand has been significant and capital flows were winged into the US have been periods where the dollar has traded above its downtrend. That, I think, is where we are now, which is why we're reluctant to basically go heavily into the dollar right now. Generally, we run two funds. One is a bond fund where at the moment we're about 50% net long in our bond exposure, and still we've got some flattening trades on. And in terms of equities, we're broadly market neutral with a slight negative bias in Europe, but I'll come on to that in a few moments. Now, let's think about the bond outlook, and let's look at what is probably the key factor right now, which is inflation. I put this chart up last month, but it stands the test of time probably for many, many months. And what it's looking at is inflation pass-through data, almost decade by decade, in terms of saying for every, let's call it every 1% increase in inflation in month 1, how much gets passed through in month 2. So in other words, what's the persistence of inflation? Now, what you find is that a little bit like a cushion, markets bear the impression of the thing that last sat upon them. So in the decade of the 1980s, after the inflationary era in the 70s, markets were very sensitive to inflation, and therefore any inflation was sort of quite quickly passed through. There was a learning effect. The interesting point to note now is that the red bar, which has been 2020 to date, is saying that what we've got is the highest inflation pass-through that we probably have seen over that entire period. So in other words, there is an inflation problem. If we get positive inflation shocks, we're going to start to see a persistent level of inflation, sticky inflation, if you like, occurring over the medium term. So I think, to my mind, what that means is the average level of inflation is likely to be higher than what we've seen recently. Fair enough. But clearly this works both ways. It works on the upside and it works on the downside. And if you get negative inflation shocks because the world economy slows and these bottlenecks disappear, then this can equally work the other way, and it can cause inflation to sort of become more benign. And that is the case, I think, that we need to explore. Now, what I've shown here on this chart is the 10-year break-even inflation rate in the US, which is the red line. And charted alongside is a very simple factor model. Now, I've shown this factor model before, and all it consists of is basically 4 variables. One is copper prices, 2 is gold prices, 3 is the Australian dollar exchange rate, and 4 is the US ISM manufacturing index. And those 4 factors explain the bulk of the variation in break-even inflation. And if you look at the data, they're peaking. And if you actually, this is end June data, but if you roll, update this for the last week or so, the yellow line's going down a bit more. So it looks as if inflation pressure has peaked. And that's clearly a good sign. And it would suggest that bonds are not a bad place to be, particularly if you're worried about, or quality bonds, if you're worried about the effects of a dislocation in liquidity. Now, the question we need to explore is the world economy really peaking? And therefore, can we expect to see some tempering of this inflation pressure? Now, what I've shown here is the track of our global liquidity index in red, advanced by 9 months. So that's the red line shifted forward. And the yellow is the World Business Outlook, which is basically all the major business surveys worldwide, from the US ISM to the Tankan in Japan, to the UK CBI survey, to the to European surveys, INSEAD in France, etc. And all these things are weighted by GDP and put together. And what this basically illustrates is better than the PMIs, by the way, as a leading indicator. And what this basically shows is the temperature or the tempo of the world economy. Now, global liquidity has been a pretty good predictor of what's going on. And the peak in global liquidity that we saw at the end of 2020 should be telling us that the world economy is peaking sometime around the middle of this year or thereabouts. Now, one other example which shows an even longer track record, which is works remarkably well, is to show this in microcosm for the UK. The yellow line on this graph is UK liquidity, advanced here a little bit longer, 12 months. And the red line is new orders, according to the Confederation of British Industry in the UK, for UK manufacturing. Now, that ain't a bad relationship. In fact, if you look at an R squared of that, it's about 0.35, which is basically a correlation coefficient of about 0.6. So it's very high correlation. And what this is basically illustrating is that you're looking at a prospective inflection coming in UK growth. Now, the May flash GDP estimate in the UK was below expectations. And I think that is, a heads up to maybe what's coming. And if you look at the data, there's been a pronounced tightening in UK money markets over the last few weeks. And that's what the liquidity data is saying. And therefore, I think you're going to see some disappointments coming in terms of UK growth. So the Boris boom that we were enjoying is probably going to disappear quite rapidly. Looking more generally, this is our World Economic Surprise Index. Let me just explain how that's put together. What we do is we take all data releases that go through Bloomberg, and we compare those systematically. This is just a mathematical program. We compare them systematically with analysts' expectations. And where you get positive surprises, we think that's an increase in economic momentum. And when you get disappointments in terms of outturn against forecast, that's a slowing of economic momentum. Actually lines up remarkably well with the previous data. And what you can see there is a noticeable dip going on in this World Economic Surprise Index. This is daily data. And what I'm showing you is to the end of last week. But if we update it for the last 2 days, that red line's come down a tad more. So what it's showing is an ongoing slowing of the world economy. And if you look at that, you can probably argue that sometime round about late May, maybe early June, there was an inflection going on in terms of world growth, which seems to be being borne out now by other data. Now, why is that important? Because if you look at this chart, it shows the VIX index, which is the yellow line. And what I've done is inverted that previous business confidence data that I showed earlier on, which I'm just going to go back to quickly, which is that data, the yellow bar, but taken back a bit further. I've inverted it here in terms of this diagram. And what it's basically showing is that when you get a slowdown in the world economy, volatility picks up, okay? And that seems to be, pretty much definite every time. So if we're looking at an inflection in the world economy, we should be expecting heightened volatility, particularly if liquidity is going down at the same time. Now, can we get any more clues about where the slowing is occurring? And I think we can by regionalizing the data. And what you can see here is that you've got major negative surprises underway now across Asia. The three groupings are Europe in red, where you've had a lot more positive momentum of late as the vaccine program has certainly initially been successful prior to the Delta variant jump. The US, which is in yellow, or that's the Americas, includes Brazil, Mexico as well, and Canada in there too, but the US dominates that by far. And then Asia, where China is clearly the major player, but others are involved. Now, what you can see is the rather ragged uplift from the COVID crisis, with Asia going down first and recovering first. Then we saw the US and then latterly Europe. More economies are now in sync, although it's fair to say that the Asian data in black seems to be leading. Now, if we look at China, this is the China picture in microcosm, where what we've done here is to look over the last year at the Chinese Economic Surprise Index, which is the red line, alongside the one-year bond yield in the Chinese economy, the government bond yield. And you can see that these two things line up pretty closely. And the one-year yield is likely to be foreshadowing what Chinese policy rates do. And therefore, the conclusion we've had is that you're going to see a policy easing. The Chinese announced on Friday that they were going to relax reserve requirements. Chinese banks are not really reserve constrained, certainly the bigger ones. So that's probably not really a meaningful change, but it's signaling. And the Chinese often use the RRR rate, the required reserve requirements, to signal upcoming monetary policy change. So it's likely coming. Now, it's not there yet, we've got to say, and there's probably bad news before we get good news, but we've got to think about some inflection. This is the importance of China in terms of the world economy. And what I've shown here is our index of Chinese PBOC liquidity, which is the red line, against world business confidence, that same data series, which is all the major business surveys. And what you can see here is that it seems pretty clear, certainly for the last decade anyway, that the Chinese data is leading world business confidence. And China is tightened liquidity. The Chinese economy is turning down. Maybe the downturn in the Chinese economy is a bit more than you'd expect, given the small tightening that you've had in Chinese policy here, but nonetheless it's happening, and that is adversely affecting world business confidence. So what we've got is one peak in liquidity followed by a second peak in the world economy, and that's got to be influencing what central banks do over the next 12-18 months. I think they're still going to continue with this tightening first, but I think we're getting to a point where markets just can't stand this anymore. And the reason markets can't stand it is you've got a very, very fragile debt refinancing environment, which means that everyone is sort of treading on ice here. Now, what about risk exposure investors? Here is our track of all portfolios worldwide. This is basically showing, it derives from data which shows the percentage that investors hold in equities relative to their entire portfolios. And what this basically is saying is this is a barometer which moves between roughly plus or minus 50. That's how it's normalized, with a zero mean. The tram lines we've put in here is when we'd definitely get very nervous about investing in markets at the top, and we get really euphoric about reinvesting at the bottom. Now, what that's saying is it looks as if, are we seeing a correction we could do? It's probably a minor correction. It's not coming from the above 40 area. So, we can be relatively relaxed, but it could be, a minorish correction, but it looks as if you're getting a correction anyway. Exposure is above average, and maybe it's, broadly speaking, economies are not looking as good as they were. Whereabouts do you invest in terms of markets? Now, this is a ranking market by market of, about 50 or 60 markets worldwide that we cover. And this is showing the exposure of investors to risk assets on that same scale, market by market, as of the end of June. At the top of the graph, if you can't make that out, let me just highlight the broad areas, are the Eurozone markets, topped by France. Austria is there, Switzerland's there too, Netherlands is there, plus Asian emerging markets, principally Korea is up there, Taiwan's quite high. But what you've got is those have been the leaders in terms of the rally. The tech markets in Asia have clearly had the wind behind them. The Eurozone markets have benefited significantly of late. Those look very stretched. If you look at Wall Street, if I can just about identify that, is about where the yellow line goes from positive to negative. US is just slightly above average. So relative to all assets, the US does not look that stretched compared with other markets. If you look below the US, what you find is that the UK's down there, South Africa, New Zealand, but otherwise there's not much choice. So in other words, markets look pretty top heavy in terms of this exposure. For the red bars are purely aggregates, just to help the eye. Now, as a comparison, and we don't have to look at the detail by market, but as a comparison, impressionistic, that's where we were at the end of March in 2020. Same ranking. Which market was right at the bottom there, having the lowest risk exposure we've had on record of over 50 years of data, which was the US. The US has moved up markedly, but basically that's where all the other markets have, that's where they were. And, some have moved a lot, some have not moved very much. The Eurozone's moved up a lot, like the US. The UK's moved up a bit, but not much. Switzerland, Sweden have stayed overvalued or above average, but become more overvalued. So that's broadly the picture. So if I summarize everything and then throw this open to questions, basically what we've got here is a situation whereby liquidity is turning down. We're seeing two peaks. The Federal Reserve, in our view, is de facto tightening. The debate is shifting towards more tightening. There's a lot of hard money noises coming out of the Eurozone, particularly from the German quarter, about what goes on now. I think that what the Fed is doing gives the ECB an escape route if they want to tighten. But I think central banks are moving in this direction. Is it an error? Well, on the basis that they'll cause some correction, I think it is. And the fact is that the world economy can't take a situation of tightening, not least when you've got this huge amount of debt. So we're back to this fragile environment. Volatility will pick up. I'd have some bonds in a portfolio, not because bonds are going to deliver returns over a 5-year period, but because actually they're quite a good hedge against equities. And equity markets, I think, are due for a little bit of a sell-off upcoming. Nothing disastrous, but I think enough to make us a little bit uncomfortable. So let me turn over to see if people have got any questions. And if there is a chat, I'll open that up too. There is a chat, which is, let's have a go. ECB question. Is it the same dynamic from, sorry, I've missed out a bit here. There's a bit before. Right, okay. Do we see the ECB's new framework or an increase in ECB asset purchases, a drain on global liquidity, that it would drive the US dollar higher? Okay, and there's a follow-up to that, which is basically, is this like the 2015, early 2016 period, where the ECB was a major driver of tightening in US liquidity? Well, let me deal with the first thing first, what I think about an answer to the second. I think the thing is that in terms of the ECB's framework, I don't think there's any dramatic changes really. I think a lot of these things are sort of words or comforting words that are coming out of Lagarde. But basically, who's driving ECB policy? I still think that Germany is driving this. And at the end of the day, what you've got is German hard money, which is in charge of the ECB, and they may give the ECB a little bit of slack. But broadly speaking, I think if there is a serious issue about liquidity or overheating, then you're going to see more tightening. Now, where you're seeing inflation, particularly in housing markets, is in Germany. And the German economy is doing rather better than other areas. And therefore, I would think that the pressure has got to be on. I don't see the ECB as a leader, maybe at all, or ever, or certainly in this cycle. It's really going to follow what the US is doing. Is it going to cause the dollar to spike? It's possible near term. I think that all this thing is pointing to the fact that if the ECB goes later, then the dollar may well have a period where it outperforms. That's possible. My concerns are more medium term about the dollar. Is there's an awful lot of money in the US dollar already, and the US has benefited from almost a perfect storm over the course of the last 10 years, which has driven the dollar higher. Let me go to another question, which is George Fox's, which, are you still constructive on equities longer term despite a short-term pullback? Well, I think the answer is yes, because I think equities are almost the only game in town. For the simple reason, if you look at bonds have been made unattractive. Now, although I said I don't think there's a serious inflation problem earlier on, the comments I was making about the persistence of inflation still suggests to me that the underlying level of inflation will be higher than people expect. I don't think that yields will reflect that, and so you're going to get negative real yields, and that's the environment policymakers want to engineer anyway. And so I think the returns for bonds over the next 5 years are going to be very disappointing, and therefore you've really got to go into equities or possibly into the housing market. Now, if you look at the long-term record of housing and you look at what is the best inflation hedge of all assets, the answer is that comes out absolutely clear, is that housing is the best hedge against inflation, or residential real estate in general. So that's what I would say there. So should you buy on a dip? Yeah, but I think you want to see, let's look at the whites of the central bankers' eyes, and you've got to see them beginning to turn. But I think they will. Giselle is saying, overview of the makeup, the tilts in the equity portfolio. Yeah, okay, the tilts in our equity portfolio are that we're more benign towards the US and the UK. We've got a slight underweight in Europe or Eurozone, not dramatic. We've had more of a short in China, particularly over the last month. We're neutral again in Japan, and our China position, which is still short, has been closed a bit. But broadly speaking, relative to where we normally are, it's a pretty market neutral stance. We're not a lot net short or net long, a small net short, if that makes sense. Right. I think that's all the questions I can see. I'm happy if anyone wants to unmute.
Michael, can I ask a question verbally, which takes less than time? It's interesting. I mean, it's an observation, but perhaps you have a comment around it. It's interesting that on the way up with liquidity, the markets seem to be very keen to jump the gun like last year. On the way down, when liquidity contracts, the markets take a lot of persuading before reacting on the way down. So I was wondering if you have a comment on that. And then separately, I'm a little bit confused by two charts that seem to say something different. One, which is one of your traditional at the beginning, which has the equity exposure versus amount of liquidity in the system for the US, that looked like the US was quite high. You said just short of the 2000 peak. But then this latter chart, page 34, which shows that the equity exposure in the US is really very much towards the middle of the sort of quite average. So I was wondering, why do the two not say the same thing? Thank you.
Okay, the answer to the second question first is that the latter chart, which basically is showing these indexes, basically do two things. One is that they trend adjust. Now, that's not going to make a big amount of difference, I accept. But the other is they bring into account other assets. So what that's saying is relative to the entire portfolio, what you've got is equities don't look so stretched. And the reason for that is that bond values have actually elevated significantly, because bond yields, generally speaking, over the last 2 or 3 years are down significantly. So the value of bond holdings has also gone up, particularly recently. So that's the explanation. If we'd have looked at that that reading for US equities as an index a month or so ago, it would have been, if I remember rightly, about plus 22, so quite elevated. And where it is at the end of June, because of the rally in the bond markets, is about plus 6. So that's basically why. And I think it's a question of interpretation, but broadly speaking, I think that the message I would take away is that the equity markets generally are looking elevated against liquidity, but I think there are markets which look more stretched perhaps than the US right now, which is particularly the Eurozone and some of the smaller Asian ones. Those are the ones I think look more vulnerable. On the first part of the question, Stefano, which is saying about liquidity, typically speaking, what you find is that liquidity, and let me maybe go to a chart which could explain it, or could, if it doesn't explain it, highlight it at least, is this one. And what you've got here is looking at all assets. Now, I think that's what you can say is that very typically, if we go back and you can see my pointer, this is saying that liquidity tends to precede increases in wealth. This is dominated by financial assets. There are periods where it's coincident, as you can see, and it's a little bit here, but generally liquidity has led. But it's often the case that what you find is that liquidity, when liquidity comes down sharply, it can take markets some time to react afterwards. Now, that's probably normal because risk appetite tends to cascade, after a drop. So, maybe you can see it again here. You've had the drop in liquidity. You've had the drop in liquidity here. I'm trying to find another example. Drop in liquidity here. 6 months later, you tend to find that the market drops. So I think it may be a timing issue. Whereas if we look, I'm trying to squint at this and see, there are more occasions where the blue and the red align themselves more closely on the way up than the way down. So I think that's, I think that that is not inconsistent with history. You do tend to see that phenomenon, and it's a little bit like, I don't know, what's that great cartoon in the US, Roadrunner, when Roadrunner runs off the cliff and is sort of suspended in space with legs moving rapidly, but then suddenly drops. So I think that's what I would tend to think about. It's really a question of timing on that.
Thanks, very interesting.
So another question I've got here, which is one from Worth again. IMF member countries are floating the idea of large-scale SDR issuance in coming months, perhaps in the neighborhood of 700 billion. What would the impact be on global liquidity? Would that give us a new upswing? Well, in the context of 100, I mean, the amount of liquidity globally is we're talking about what, 160 odd trillion of liquidity. 700 billion is relatively small amount. You could say, well, okay, that could be leveraged and therefore it can increase. Yeah, possibly. But I think the question is that where that would be distributed would be more among needier users, so emerging markets or frontier markets or whatever, which would have less of an impact. So, I think that's more a cosmetic thing. I mean, what really matters at the end of the day is 2 or 3 central banks, and I'd almost say 2. It's really what the People's Bank of China is doing and what the Federal Reserve is doing. And, you know, the People's Bank of China responded to some extent to the COVID crisis. Nothing like the ECB or the Fed did. The Fed did huge amounts, as we know. The Fed's sort of coming off that stance now. I think it's going to be unlikely that the Fed will, quickly turn. We may have to look for China as the first mover here, and to see whether China begins to move more liquidity into the market. That still may be a few months away, but I think we're moving in that direction. And the weaker economies get, the more the case is built. But I think that, I would tend to believe that unless there is a serious dislocation in markets, that the Federal Reserve is unlikely to move again until next year, maybe even, maybe sometime after that. So I think we're still on a liquidity downswing until we're not. But it's China which I think is going to be the leader in all this, and the slower Chinese economy is going to is something I think to watch. But broadly, I wouldn't put a lot of weight on what the IMF is doing. I think the interesting point about this whole international global backdrop, which counts for quite a lot, is to go back to what was called the Shanghai Accord back in 2016, which may be what Worth is alluding to in the question. And then there was a coordinated attempt by central banks to weaken the dollar, and they did agree a substantial generalized expansion in liquidity. Now, coming out of that, I think that what has occurred is also what you might call perhaps even a Bretton Woods 3, to use that analogy. And that is that what you've got, what has come out of the Shanghai Accord is remarkable stability in Asian currency markets like I've never seen before. You've seen virtually flatlining of all these units, certainly collectively against the US dollar over that period. And it looks as if there's deliberate targeting going on. So that's something I think to pay attention to. So if you get any strength in the dollar, there may be pressure being put to do something globally. But I think generally, I would still say that this is unlikely to be, this 700 billion, unlikely to be a big impact on global liquidity, just in terms of size. You're looking at $160 trillion pool against what, 700 billion here of money. And if there are any other questions that people have got, I'm happy to take a few more if you do. Doesn't seem as if we've got any more, but I'm going to hang on for a couple of minutes. What's my view on sterling? I think that sterling looks, I mean, look, basically, sterling is a halfway house between the dollar and the euro. I mean, that almost goes without saying, but the performance of sterling pretty much matches that. I think that, what I would argue is that generally over a medium-term view, I tend to think that the euro is going to appreciate against the dollar. Now, I hesitate about whether I've got conviction about that near term, but on a medium-term view, I believe that. And the reason that that is true is, or why I think that's true, is that number one, you've got a situation where there's this huge amount of safe assets in the dollar already. So this perfect storm in the last decade. And the other is that if you look at what's going on in the Eurozone, there is increasing polarization towards Germany. The rich are getting richer, the poor are getting poorer. And effectively, the euro is more and more the old Deutschmark. And I think that with the strength of the German economy and maybe the increasing importance of Germany within the Eurozone and maybe even within the ECB, I still think that markets are going to see that for what it is, and the euro will basically benefit. I think that if you get any inflation scares, the euro is a low inflation currency just by history. So I think the euro goes up. I think that sterling therefore should appreciate medium term against the dollar mildly. It's already had a good run. In the short term, I'm less convinced. And I'm less convinced by that because what we're seeing is this sort of sharper downturn in UK liquidity, which I think will adversely affect the economy And I think any economic disappointments over the next 6 months will cause sterling to come back. So notwithstanding a view that I think that sterling may well hold its own against the dollar on a medium-term view from here, I think in the short term, you may see some disappointments. Good. Okay. Okay, that's it. Great. Okay. Thank you, everybody. There'll be a recording of this available, and I'll send the charts out. But thanks again for your time. I hope it was worthwhile, and we'll do it again next month. Thank you. Goodbye.